Now we've gone over everything from top to bottom as far as the 7 main streams of income. Obviously, we didn't talk about earned income because you're retired. Why are you working? But I find that the best strategy is always to be able to combine the different pieces of income into a retirement plan. And the reason is because everyone has a strength and a weakness. There's times that the rental property will do better. There's times that the stock market will do better. There's times that the stock market and rental don't do well, and then your business can keep you afloat. There's times that your business is slumping a little bit, but you have the safe investments in the interest income. And then you have the dividend income that even though the stock may not be growing or appreciating as much as the normal stock, but because they're paying you a dividend, your total return is actually pretty nice. Hi, it's Dre Griggs with Obsidian Wisdom. Today we'll be answering the question, how much money do I need to retire with $100,000 per year in income? That is a great goal that all of us should want to achieve. And as you guys are well aware, I tell you all the time, the IRS has done the hard work for us. They've given us the 7 streams of income that they recognize. In all of my plans, we focus on how do I create at least 3 streams of income in each of my clients' lives. That is because the IRS has said that 65% of self-made millionaires have at least 3 streams of income. Now, 4 streams, you'll find that 45% of millionaires have that. 29% of millionaires have at least 5 or more. So not at least, but 5 or more streams of income. So we'll talk about the streams that you can passively work on so that when you retire, you have money coming in every single year, every single month, and however the frequency that you want, so you don't have to worry about it, which is what we all want to do. We want to be able to have more experiences, more fun, more joy with our family, and less financial concerns and worries and struggles. Now, before we get started, these numbers are not going to be very small. These are going to be pretty relatively large numbers as far as what we need to achieve, which speaks on the fact that you need a long-term plan in place. I'm not going to blow smoke up your butt and tell you that we're going to find this crypto stock and you're going to become a billionaire tomorrow. But I will tell you some sound strategies that you can use and mathematical formulas for you to exactly know what needs to be done for you to have those streams. So the first one on our list is investment income, which is a very fancy way of saying dividend income. If you want to have a dividend investment strategy where you find companies that pay out a dividend just means the company is making its profits and you as a silent partner, which is what you are as a stockholder, you have ownership in that business. They decided it's in their best interest to give you as a stockholder the money back. If you want, it depends heavily on the dividend yield, which is a very fancy way of saying how much of the money that the stock is worth do they give me basically as a percentage. So if the stock was $20 and they gave $1 back in a dividend each year, that would be a 5% dividend yield. What you would do is you would take the $1 and divide it into the $20. So that would give you 0.05, which is 5%. If you needed $100,000 per year and you had a 10% dividend yield, then that means that you would only need $1 million in your portfolio. Now you may ask, well, Dre, how likely is it to have a 10% dividend yield? And I would say that it's probably kind of difficult. Like, just to be frank with you, the average is about 2% for the stock market. And then if you have, it really depends on the earnings per share. Generally speaking, if a company is willing to give, let's say 50% of their earnings per share. So if the stock is worth $10 and the earnings is $1 and they give you 50%, so that's a 50% earning per share. That's a great dividend return, but the yield, right? So then that 50%, the 50 cents into the $10. So the yield is not very much. But if you are gonna go with the conservative 2% average, then you would need $5 million invested in your portfolio to be able to have $100,000 per year in an annual passive income for retirement. Now, if you have the time and you can allocate the money, I can show you mathematically how investing 20% of your income over 10 years is going to achieve a very nice result. I just did a plan for a guy, and I mean his worked out where he could do like everything that he's doing. I think it was like 5, maybe 10% of his salary. And based on the debt that he didn't have, it really worked very nicely for him. I think he was going to end up with like $7 million when it was all said and done. But at the same time, if you increase that, so if you were to give $2,000 every single month of your salary, let's say your kids are gone and they're in college and all this other stuff, you have the money where you can really make up for lost time, that could be an option for you. Number two we have is capital gains. So capital gains means that you hold the stock for 1 year and 1 day. If you hold it for 1 year or less than a year, it's considered active income, just regular earned income, and is not given the favorable tax advantages of capital gains. Capital gains, again, depends on the withdrawal rate and what you expect your return to be. More times than not, if you're someone who's focused on generational wealth, or even if you don't want to worry about money, then you normally would have a withdrawal rate, which is how much money you take out of the big bag that you put for retirement, and you live off of that each year. If you have a 5% withdrawal rate, that would be a $2 million portfolio. That would give you $100,000 per year. So you can see that the number, right? We went from 1 million with a very high dividend yield, and that was 10%. With the average dividend yield, that'd be 5 million. If you wanted a 5% withdrawal rate, which is not crazy, that's very doable, then you would need a $2 million portfolio to have $100,000 per year. The beautiful thing about that is if you are able to maintain a 5% return on your portfolio each year, and then you withdraw 5% each year, you should have that same $2 million when it's all said and done. You should never dip into your principal, which means that you don't really have to worry about your money. Now, things obviously happen. Some years you get more, some years you get less. What do you do when that happens? And I'll make a separate video where I'll share some of those strategies where they talk about what you can do if you're worried, where it's called a variable withdrawal rate. It just means that I adjust my withdrawal rate based off of the returns I had the previous year. So every January, you'll set what your withdrawal rate is for the year, and you'll base it off of the returns you had last year. So if you had a down year, let's say you only got a 3% return, then maybe that means you only take 3% out the next year. But it really depends. The idea is, how do I smooth out my consumption so that I'm not feast or famining, but at the same time, I'm very confident and comfortable that I'm not dipping into my principal. Because once you dip into the principal, it's really hard to stop the train, unfortunately. Because if you take out 5% and then you get a 3% return, well, you just lowered your overall portfolio by that 2%, right? Well, the problem is it's compounding. We always talk about compounding to grow your money. Well, compounding can lose you your money too. So if you lose 2% every year, then it means that you don't just have to make 2% back the next year. You have to make like 8% back the next year, because you have to make back the number to get back to where you were at. So you couldn't say 5% win, 5% win, 5% win, 2% loss. So that means I need a 7% win the next year, because you have to get back to where you were at and then get 5% from there. So that's definitely something that you just want to keep in mind. But that's the capital gains. I just have my money. I'm not really focused on dividends per se, but I found great companies. I invested in those great companies, and I have at least a 5% return each year. And as a result, I can live off of that 5%. You would need $2 million to do that. The third one is your real estate rental income. So if you are someone who is interested in real estate, like physically owning the land, it depends a lot on the type of properties that you're looking for. Some properties are great for cash flow. Some properties take a lot more money up front, and you want to get the financials to understand what makes the most sense for your retirement plan. So let's say you found a $100,000 property and you had to have the 20% down payment to be able to get the house. So that's $20,000. I'm keeping the math nice and easy for me. If you're able to generate $1,000 per month, right, net, then that would be $12,000 a year, which means that you would need somewhere between 8 and 10 properties. So we'll just say 9 properties, because right, 9 times 12 gives you $108,000 a year. So if you have 9 properties at about $100,000 each, that nets you $1,000 once you pay for your costs and different things, then you're able to say, okay, I need 9 properties. If for some reason that number is smaller, then you just double it, right? So let's say you only were netting $500 a month from your property once you paid off your expenses. Well, then instead of having 8 to 10, then you would need somewhere around like 18 to 20, and then you would still have that same amount. So now you have 18 to 20 properties. But it's not unreasonable to be able to find a property that generates you $1,000 in cash flow. And I'll share with you something that one of my clients had mentioned to me, who specializes in real estate, loves real estate. And he said that he had learned that he can make more having a smaller and cheaper property than he could having a very large, expensive, massive mansion. And he said it was because there's not that much money that you're able to charge in rent. And so if you had $1 million property and you wanted to have someone, rent it out, sure, you can get a pretty good cash flow going from that. But if you found $50,000 properties and had a portfolio then where you had like 20 of them, he said most people understand that the bottom, as far as what rent is going to be, is probably going to be at least $1,000, right? Like at least $1,000 that they're going to pay in rent. And many of you will probably say rent is so crazy right now that you couldn't get away with less than $1,500 or less than $2,000. Well, you can see what the point that he was making is, even if you have a smaller property, because people expect to pay at least a certain amount, it's much easier to be able to net that $1,000 in cash flow that you need to have from each of your properties, and you're spending a lot less money. Now, granted, you have a lot more as far as the administrative costs and things and running the property, where you may have to put a small team together. Maybe you have someone else manage the properties for you. But he was just saying it's much easier for him to buy 20 properties at $50,000 than to just go buy a $1 million house. That the $1 million house, while it may give him a nice cash flow, it's not going to be 20 smaller houses. And that the math just kind of worked out. And I remember thinking, I was like, kind of thinking, crunching the numbers. I was like, yeah, I can see that. Now, you can make the argument that, well, you're attracting certain clientele and this, that, and the other. And all of that is true. There's lots of levers that go into real estate investing, which is why I often will have my clients just invest in real estate investment trust. REITs is what we call them for short. If you invest in a REIT, what happens is if you find a good REIT where these people have apartment complexes, well, you and I would know apartment complexes would be great. We're going to have lots of cash flow because we have 30 units and we'll have all these people in these units paying us. But that's so much money up front, Dre, so I don't know if I could do that. I agree. So maybe we invest in a REIT that specializes in that. If you're someone who likes the mall scene, you can invest in REITs that specializes in malls, where you can get commercial properties, like multi-million-dollar portfolios that you are a part owner in. And so I love REITs a lot. And then Warren Buffett, he's like famous he has one of these quotes where he was, maybe it was Charlie Munger. Anyways, Warren Buffett and Charlie Munger, in one of their investment meetings, they were talking about why they don't invest in real estate. And they were saying because people mess up your houses. He's like, people will mess up the house, so we don't invest in real estate. And I thought it was kind of funny and just how simple his approach is. But there is some risk. There really is risk in real estate that you want to consider and see if it makes sense for you. I know people that it makes great sense for. I know people that it didn't make as much sense for. The next one that we have is interest income. And this is the one that's going to be one of the more safer investments, where if you're someone who's very risk averse, now there is a cost to having a guaranteed return. So think of like your bonds and treasuries and different government assets and sometimes some corporate assets, where they say, look, you give me some money, I promise that if you let me hold this money for 5-10 years, I'm going to pay you back this exact set amount. So you don't get to take advantage of an amazing growth opportunity where the company goes gangbusters, and because you have stock, you can appreciate with them. This is a bond. This is debt. You're buying debt in the company. And so they pay you like any other creditor. You get the amount that is agreed upon, and you don't get any more. It doesn't matter what the company overall does, but this is nice for you if you're worried about the company going belly up, because you're in front of the stockholders because they're considered business owners. So the business owners get paid after the creditors, and you'll be considered a creditor in this particular situation. But the problem is, even if you think of like your savings account at your bank, you end up getting less than 1% of a return, which is kind of ugly. And so that really makes it hard for you to make $100,000 a year off of this. It also makes it hard to keep up with inflation. But because it is a stream of income and it is counted, and you may have a small percentage in your portfolio, I will tell you what it would be if you just focused on investment income. Investment income, it says the average money market account was 0.08%, which means that you would need $125 million to make $100,000 per year. And that a CD over the past, like 20 years as well, has had an average of 0.32%. And that means that you would need, and that was for a 5-year, and that means that you would need $31 million to make $100,000 per year. Now, you would say, well, Dre, right now, I can get a CD at like 4%. And you're right. Interest rates are up, and you can definitely get a higher return currently. But we're talking about a long-term strategy. We're talking about retirement. We're talking about you being retired for 20 to 50 years, right? And if you're going to be retired for 20 to 50 years, then you have to understand that those old interest rates that we talked about, those crazy numbers with less than 1%, that was a 10-year span, right? That was a decade of someone's retirement. And then the sixth and the seventh stream of income that we're going to kind of lump together, because the way I'm going to describe it to you is going to be basically the same, and that is profits from a business or royalty income. I find that both of these, they kind of go together, right? Most people who get royalties probably have a business of some kind, but your business doesn't have to be in royalties. But we're going to talk about some very simple strategies. Now, if you are saying, all right, Dre, I needed millions of dollars basically to retire these other ways, this is the one where if you're cash strapped, that makes the most sense for you to be able to get started. And it really, the numbers, will work through them, and I will give you some examples in each of them. But the leverage of having a business is you are able to get people to give you small amounts of money that adds up to a larger amount of money. And then you're able to fund your retirement. Making $100,000 a year in a business is not asking a lot of a business. Like, if you really think about it, because if you had a $10 product and you only had to sell 10,000 units, that would be $100,000 per year, right? Again, there is hundreds of millions of people in this country. There's billions of people in the whole world. Can you get 10,000 people every single year to give you $10? I would say probably so. And that could be like PDF downloads. Yep, people pay $10 for that. You make t-shirts, books. Yep, people pay $10 for that. Could you sell 10,000 of those? Of course you could. You can definitely do that. And so you have these opportunities. And then if you just move the number over, then you can move the number over. And what I mean is, instead of charging $10, what if you had a $100 product? Well, then you don't need 10,000 units. You can take off one of the zeros off of that side, which means you only need 1,000 units. So if you have 1,000 units sold of a $100 product, again, now you have $100,000 per year. And that could be like a membership site where you show people how to paint or knit or to film a video or to do investments. Like, there's so many things that you could do that provides enough value that people will be willing to pay you for it, and you only need 1,000 people per year inside of it. And so you could do like video tutorials. There are so many things that you could do where you could charge $100, and then if you have 1,000 people that do that, bam, you got $100,000 per year. And to start these businesses, the investment in them is much smaller than the investment in having the fund of some kind. But everybody obviously doesn't want or doesn't like to do a business. But I'm simply saying that it's another stream of revenue that you can use to fund your overall lifestyle, and then you can leverage it. The top 1% has over 50, I think it's like 55% of the stock market in America is the top 1% of wealth. The top 10% of wealth in America owns 80% of the stock market. Like, let that sink in for a second. 80% of the stock market is owned by the top 10% of wealth in America. And if you look at the list, you're going to find that a lot of them are providing services to a large number of people that provides value for them. Now, you could go like next level, and if you want to charge $1,000 for a product, maybe you have a very in-depth course, where if you have a course that can generate more than the people are investing, where they're getting a win by giving you $1,000, then you only need 100 units to be sold per year. If you charge $1,000, you only need 100 units to be sold in any given year. And then you'd have the $100,000. And then if you wanted to go all out and have an all-inclusive mastermind of some kind where everybody flies out and they meet you and it's a very nice, inclusive, or again, if you provide a value that is more than, generally they say, if you can provide a value that is 10 times more than the cost that they would pay to invest in it, then you got a business and people are going to love it. So if you were to sell something for $10,000 per year, then you would only need to sell 10 units. $10,000 per year product, 10 units is all you would have to sell. And you could have a full-blown experience for someone, and it may include all sorts of bells and whistles, and then people are saying, this is great, I love this. Right? I remember when the Amazon first came out with the Prime shipping, and I think it was like $50 or $80, $100, something like that. Well, it's gone up each year, but people still see the value in it. Even though the price has gone up each year, people are like, it's still worth it. Like, that is very beneficial to me. There are other services where people would charge a significant amount, right? Like, if I told you right now that I had a Ferrari for $10,000 you would find the $10,000 because the value that is being offered significantly outweighs the cost of the investment. And so all you have to do for business and entrepreneurship is provide such an immense value that when people pay for your service, they're going to be like, this is a win for me, right? Like, this is a win for me. I like this. And that's all you have to do in business. So royalties could be if you focus on like books, where you make a book and then you get paid a royalty for it. If you had a course on Udemy, they pay you essentially a royalty. You put it up, you pay the course, and then they keep a portion, you keep a portion. You know, YouTube is the same way. YouTube, you can run ads on the videos and you get paid like essentially a royalty from the videos that you've run. Probably the most beneficial way, and I tell you guys all the time, wealth is how much value you create in other people's lives. That is a measurement of how much wealth you have. You can create wealth by investing in other companies and then taking part in the profits of the value they provide. You can create your own company. You can buy real estate and give people places to live at. That is an immense value. So people are willing to pay more for that. And so you just have to decide, how much value am I going to create? Am I going to create value in one person's life, 10 people's life, 10 million people's lives? Because depending on how much value you create in everyone's life, it will tell you how much you need to do. Now, we've gone over everything from top to bottom as far as the 7 main streams of income. Obviously, we didn't talk about earned income because you're retired. Why are you working? But I find that the best strategy is always to be able to combine different pieces of income into a retirement plan. And the reason is because everyone has a strength and a weakness. There's times that the rental property will do better. There's times that the stock market will do better. There's times that the stock market and rental don't do well, and then your business can keep you afloat. There's times that your business is slumping a little bit, but you have the safe investments in the interest income. And then you have the dividend income that, even though the stock may not be growing or appreciating as much as the normal stock, but because they're paying you a dividend, your total return is actually pretty nice. And so I find that if you place all of these together in a comprehensive retirement plan, that you're able to create not only a retirement income of $100,000 per year, but something that you would be able to pass on to your children for generational wealth. Like if you had a portfolio of real estate and you pass that on to your children, you have created a income stream that maintains and preserves past you. And the same would be true with your dividend investing and the other stocks, right? If you have $1 million, $2 million, $5 million invested in the stock market, well, now you have the ability to be able to pass that on to your children, even though you lived a fabulously wealthy and lavish retirement. It's the beauty of generational wealth. It's why generational wealth is so much more than giving someone a bag of money. It has to do with how we figured out how to create generational wealth and how we teach our children how they maintain generational wealth, and require your children to teach that same process to their children, and so on and so forth. You can't just give someone money in a bag and be like, hey, I died, here's $1 million life insurance policy, and expect your children to know what to do. You have to be able to figure it out yourself so that you can teach them and that it can keep on going for generations to come. If you enjoyed this video, you found value in this, I simply ask that you like and subscribe as we continue, and I keep giving you insights and valuable information on how to unlock generational wealth through strategic retirement planning. Until next time, continue blessings.